In January 2026, three massive economic forces, each with a history of wrecking markets, are on a collision course for the first time in a generation. The warnings are already here, flashing red, but somehow most investors are looking the other way. Now this isn't about fear-mongering, it's about connecting the dots here. It's about looking at the patterns that have repeated for centuries and understanding that the financial world we're in today is not normal. What you're about to hear is a blend of hard data, historical cycles, and frank warnings from some of the sharpest minds in finance. We're going to break down why this date matters, what these colliding forces are, and most importantly, what you can do to not just protect yourself but to find incredible opportunity in the chaos. Because when the herd panics, the prepared investor finds their fortune. This is not financial advice, and I'm not a financial advisor. This is education and entertainment purpose only. Let's start with a pattern that's practically written into the DNA of modern economics, the 18-year cycle. First identified back in the 1930s by economist Homer Hoyt, and later championed by Fred Harrison, who famously used it to predict multiple crashes. This cycle has been ticking along with eerie consistency for over 200 years. It's a predictable rhythm of boom and bust driven by the one thing our entire economy is built on: real estate. The cycle is stunningly simple. About 14 years of growth capped off by a brutal 4-year recession. Think about it. The last global catastrophe bottomed out between 2008 and 2011. Do the math, add 18 years, and where does that land you? Well, right on 2026 doorstep. And this isn't a coincidence, it's the cycle. In fact, Fred Harrison has gone on record predicting the next major crash will climax in 2026, a forecast that perfectly aligns with his life's work. Right now, in late 2025, we're in the final, most dangerous phase of the cycle, what's known as the winner's curse. This is that euphoric, frantic peak where a feel-good factor fools everyone into thinking that the party will never end. It's a stage defined by a wild overconfidence as people pay prices for assets that make no logical sense. We are seeing this play out right now, but history has a perfect track record here. This phase always ends in a painful correction. This historical rhythm is the first storm front gathering on the horizon for 2026. The second, and maybe the most obvious threat, is the absurd overvaluation in the stock market. We are living through one of the most expensive popped-up markets in history, and two of the most trusted valuation metrics are screaming danger. As mentioned before, the Buffett indicator, Warren Buffett's own favorite yardstick, it just compares the total value of the stock market to the country's GDP. Buffett once said that near 200 you're playing with fire. The last two times it got that high were right before the 2000 dot-com bust and just ahead of the 2022 bear market. Well, as of late 2025, the indicator has been hovering in dangerously overvalued territory. We're officially playing with fire in a forest that's bone dry. Then there's the Schiller Cap E ratio, which basically is a souped up PE ratio that smooths out the decades of earnings. It has an uncanny knack for spotting bubbles, and it's currently sitting at its highest level in history, only outdone by the absolute mania of the dot-com peak. And this isn't just theory. Look at what's driving the market. We've got an AI-fueled frenzy where some company valuations have left orbit and are headed for another galaxy. Some analysts, like those at Capital Economics, have put a date on it, warning that this AI bubble is set to pop in 2026 as reality finally catches up to the hype. The excitement has pushed the S&P 500 to record highs, but a lot of it is built on a foundation of buzz, not solid earnings. Even Wall Street insiders are getting nervous. We're hearing warnings from prominent voices in finance about a potential 10 to 20% drop in stocks over the next couple of years. This isn't a fringe prediction anymore, it's a mainstream admission that things have gotten way too out of hand. This isn't a healthy market, it's a bubble, and there's only one thing bubbles do. The third force converging on 2026 is the debt supercycle. The United States and much of the world is choking on a level of debt that would make the past generations famed. As of November 2025, the US national debt is projected to be over $38 trillion, a number so large it's almost meaningless. The country's debt to GDP ratio, a key measure of its ability to pay its own bills, is on track to blow past its World War II record high later in the decade. Some economists are warning these fiscal positions are becoming flat out unsustainable. What makes this debt bomb so little right now, well, is interest rates. To fight inflation, rates have shot up, which means the cost of just servicing this mountain of debt is exploding. Net interest payments on the US debt are projected to soar towards $1 trillion a year later this decade. To put that in perspective, interest payment on the national credit card is set to become larger than the entire defense budget. This leads to two terrifying outcomes. First, it squeezes out everything else. Money that could have gone into innovation and infrastructure gets thrown into the furnace of interest payments. Second, it makes the whole system incredibly fragile. High debt and high rates are a recipe for defaults and a credit crisis. This is exactly why the world's smartest most investors are running for cover. Warren Buffett's Berkshire Hathaway has been stockpiling cash. As of late 2025, the company is sitting at a record-breaking hoard of well over $380 billion. This isn't indecision, it's a strategy. Buffett sees a dangerously overvalued market and is waiting for the storm to hit so he can buy good companies at a discount. He's following his own famous advice: be fearful when others are greedy. The fact that the Oracle of Omaha is hoarding cash is one of the loudest alarm bells you can get. And if this is making sense to you and want to stay ahead of these tidal waves in the market, do yourself a favor and subscribe and hit the notification bell. Beneath all the financial wizardry, the very foundation of the economy is showing deep, ugly cracks. The real estate market, the engine of that 18-year cycle, is sending off some seriously worrying signals. While some headlines might predict a small price gain, that's not the whole story. An affordability crisis is crushing real demand, and several major housing markets are already projected to see prices fall heading into 2026. This is classic winner's curse behavior, one last desperate surge before the floor gives out. Some economists believe a major downturn is set to begin in late 2026. And if real estate rolls over, it could be catastrophic for regular families. For millions, their home is their biggest asset. A plunge in home equity would vaporize consumer spending and trigger a wave of financial pain, creating a feedback loop that could pull the whole economy down. This financial weakness is being made worse by another more toxic cycle: skyrocketing inequality. The gap between the super rich and everyone else has widened to a level not seen since the 1920s. Sound familiar? Well, it should. That was right before the Great Depression. And this isn't just a talking point, it's a massive economic risk. History shows that extreme inequality breeds social and political instability. Protest, unrest, political chaos, it all pours gasoline on an economic fire. We're already seeing signs of this social fabric tearing, and a market crash would only shred it faster. And the final factor, the true wildcard in this perfect storm, is geopolitics. The world of 2026 is shaping up to be a minefield of tension and shifting power. We're facing a storm of risk that could easily be the trigger for a financial crisis. Ongoing conflicts and a threat of new ones create brutal uncertainty, messing with everything from trade routes to energy prices. Trade itself has become a weapon, with the constant threat of new tariffs making it possible for businesses to plan ahead. We're seeing a global shift where major powers are looking out for themselves, leading to a much more fractured and unstable world. On top of that, the rise of new economic giants like China and India is redrawing the global map of power. Combine that with political instability and a major elections on the horizon, including the US midterms in 2026, and you have a powder keg. In a financial system this fragile, all it takes is one geopolitical shock to light the fuse. Geopolitics is no longer background noise, it's a primary risk that most everyday investors are completely ignoring. So we have a historical cycle that has been calling for a downturn for years. We have a stock market bubble inflated to historic proportions. We have a mountain of debt that's becoming unserviceable. We have cracks in housing and deep social divisions. And it's all happening in a world that's more politically unstable than it has been in decades. When you lay it all out, the picture of January 2026 looks grim. It points toward a major financial reckoning that will blindside millions. Now, I know some people will point to optimistic forecasts that see nothing but calm waters ahead, but those forecasts often ignore the powerful deep current of these long-term cycles. They see the surface, not the tsunami forming underneath. The point of this isn't to make you panic. Panic is for victims. The point is to prepare you. Forewarned is forearmed. For the prepared investor, a market crash isn't the end, it's the beginning. It's the single or greatest wealth building opportunity of a generation. The only question is, will you be a victim or will you be a victor? The key to winning in the coming storm is to stop thinking like a short-term gambler and start acting like a long-term strategist. Here are 4 moves you need to be thinking about right now. First is stop trying to time the market perfectly. Nobody can. Even the experts who see this coming admit that bubbles can inflate to irrational highs before they pop. The goal isn't to sell everything on December 31st. The goal is to be ready for the ride. Re-evaluate your portfolio now before fear takes over. If you're all in on one hyped up stock that drove this bubble, it's a time to think about trimming that risk. And next, let's look at the biggest lesson from Warren Buffett. That massive cash pile of his isn't just sitting there, it's a weapon waiting to be used. A market crash is a fire sale. Excellent companies get sold at a massive discount. The people with cash on the sidelines, the dry powder, are the ones who get to buy incredible assets for pennies on the dollar. While everyone else is panic selling their future, the prepared investor is shopping. Third is to focus on real tangible assets. In an age where governments can print money out of thin air, owning things that have real intrinsic value is critical. As commentator Robert Kiyosaki often says, you need to know the difference between fake money and real money. Historically, assets like gold have been a safe harbor against inflation and currency chaos. Even central banks are buying it up. This isn't about ditching stocks entirely, but about diversifying into things that can't get devalued with a keystroke. And fourth is adopt a long-term mindset. A market crash only destroys your wealth if you're forced to sell at the bottom. If you're invested in high-quality companies with strong financials and real earnings, a crash is just a temporary dip on a very long journey. As Buffett says, a crash need not matter to you. Your focus shouldn't be on the daily market drama, but on the decade-to-decade growth of your wealth. The greatest fortunes aren't made by timing the market, but by time in the market, as long as you are invested in quality. So this isn't time for fear, it's a time for preparation. It's a time to question the "this time is different" narrative and learn from history. It's time to rebuild your cash, reevaluate your risk, and ground your strategy in real long-term value. The coming correction will create losers, but it will also create a new generation of winners. A staggering amount of wealth will change hands. The only question left is on which side of that transfer will you be? Thanks for watching, and don't forget to like and subscribe, and I'll see you guys in the next video.